Check, please.
Paul, we are back here with Everything Money. I welcome you in, my dear friend. This is a question we get in our community all the time. A very standard, normal person might think, why does a company report great earnings in the news and everything's fine and dandy, and the stock price tanks or rises on bad news? What is with this discrepancy in the stock market? I'd love to hear your thoughts.
So a lot of times a company can report record profits and record revenue, but still fall because their guidance was bad or it didn't go up as much as analysts thought. But the reason I'm interested in Qualcomm, and share my screen real quick, Seth.
Go ahead.
Qualcomm, if you look right here, its guidance for second quarter, it expects adjusted earnings of $2.80 to $3 per share on revenue of $10.2 to $11 billion. Their analysts had expected $251 to $9.66. So they're already forecasting way better than analysts expected. They reported $10.71 billion, which was an increase from 8.24, and analysts had expected $10.44 billion. So they crushed analysts' expectations.
Yes.
And look at the stock today. Let's go to our Everything Money software, Qualcomm.
And for the dummy and me, Paul, what is guidance? I still get a little confused on that.
They get on phone calls with analysts. They talk to them and say, hey, we think this is going to happen. This is going to happen. This is where we think we're going to end up. This is where we think we're going to go, etc. The stock is down 3%. So they beat analyst expectations. They had record profit and revenue. They guided better than analysts had expected, and they're down. This, to me, is a sign of where we are right now, early on in this year. It doesn't even make, if I told you ahead of time that this company would beat everything that they said they were going to do, everything analysts thought they're going to do, they're going to have record profits, record revenue, and say we're going to do better than you guys think, the stock is down. Please make sense of that for me. This should be your indication that news does not matter. What matters is the long run. What matters is the long run. This blip is exactly what's wrong with investing, with following hype. This company, I remember being like, oh my God, how are they down? Well, we also had Facebook down 25% today. Overall, NASDAQ is down a lot today. That's probably driving a lot of this, right? What the heck? This is ridiculous, guys. This is absolutely ridiculous. And this is what I want everybody to understand. Like, this should not make sense to you. And if it doesn't make sense to you, there's a better way to understand it. The better way to understand it is all this noise doesn't matter. You should worry about the future. You should worry about years and years from now. Is Qualcomm a good company? Are they growing? What is the chip sector going to do in the next 10 years? And is Qualcomm the company I want to be in for that? That's the question you should be asking.
Yeah, Paul, Warren Buffett said something that I had to grasp, is the concept of when I become a part owner of a company by buying shares of their stock. He said, I want the deal and the company to be so great that the stock market could shut down for the next 5 years and I'd be perfectly fine. How does a normal
investor? Go ahead.
I mean, how does a normal investor who loves staying on social media like me and staying with it with the news and in with the times, how do I block out all this noise when a company I like maybe is in bad favor? I mean, teach me as you're teaching our viewers.
I cannot teach that besides saying probably the majority of our viewers work for a small business. That small business is not publicly traded. That small business is exactly what Warren Buffett says. The market has shut down for 5 years. Because the only thing that's going to matter is when that person, that small business owner, decides to sell their business in 5, 10, 15, 20 years. That's when the market will matter. So all along the way, if you worked for a company and I was your CEO, we're not publicly traded. I just own the company. And I say, guys, we had record profit, record revenue, and we think we're going to do even better than we thought before. Would you say, oh my God, this company should be down. Our value is down today. You'd be like, oh my God, our value is up. Mm-hmm. But you look at the stock price of Qualcomm, and it's everything I just described, and it's down 3% today. Explain that to me. This is where it should be obvious to you that Mr. Market is wrong usually. Mr. Market's going to be wrong a lot. Your job is to be a buyer or seller based on Mr. Market. Now, just because it's down today doesn't mean you should go buy the stock. You still need to use like the stock analyzer tool and see where it's going in the future to determine if you want to buy it today. Is it a good price today? If it's a good price today, assuming a good future, a decent future, then buy it. Like Facebook, I'm a buyer of Facebook today. I'm not saying you should go do it. Me personally, I'm increasing my position on it. That's it. Because why? I think the market is over exaggerating. They still had record revenue, record profit, but they're just not going to. They just guided poorly. They're down 25%. Okay, I look at that as Mr. Market being crazy. I'm okay with that. The hard part about investing isn't the numbers. It's this. It's the stomach. It's the heart. It's doing that. That's the hard part. Because you have to be able to say, I'm okay with the stock price being down, even though I think the future. Alibaba, prime example. I'm into Alibaba for like 155 a share. It's at 122, 121, something like that. Most people would be like, oh my God, I'm down 20%. I'm wrong. I'm looking at going, I think I'm in it for 10 years. I'm in it for a long period. I think Alibaba will be around for 10 years and will be more profitable and generate more revenue 10 years from now than it does today significantly. Okay, we're good. That's all I care about.
So, Paul, the people that oppose us and think we're really stupid, they say the same things you just said, that they think the companies that they like are going to be way up and they're disruptive and they're going to change the world, the Palantirs of this world, the tattooed chefs of the world. So what's the difference there? You know, both channels are saying the same thing. So what's the difference between a company?
They're paying mature price values for companies that aren't mature yet. They just don't understand value. They're not looking at the market cap, looking at the stock price, and they're stupid. And they're absolutely effing stupid. And if you listen to them over a long period of time, I guarantee you will not do well. That's it. If you listen to the things we teach and apply your own principles to that make sense to you, you will do very well. Even if I match the market, my downside risk is lower than the market. If I just match the market returns over a 10-year period, I'm fine with that because my downside risk is going to be lower. I'm not going to have 80, 90% losses in my stocks. Palantir is already down 70% from its peak 6 months ago. Tattooed Chef's down how much? Neo's down how much? Nikola, all these ones, Workhorse. Oh my Lord, all these stocks are down so much. Give me a break. If you really believe that's correct, they can't tell you why these stocks are down. Look at Workhorse. Look at Workhorse, $3 a share.
Yikes.
$3 a share. We were called stupid for saying I wouldn't touch the stock right here. It's down 96%.
Oh my gosh.
And then that idiot trader Stock Mo, that effing moron Stock Mo, said I'm gonna own Workhorse for the long run. I don't care if it doesn't get the contract. He was out at 17. Smart guy. He was out at 17 or something like that. It's down $3 a share. This is an Ohio-based company. This is a $10 billion company just 1 year ago. It is now a $380 million company. I have one thing to say to everybody who said I was wrong on this one. Loser. I could be wrong about Facebook, Alibaba, all of these ones. This alone makes me go, you didn't know anything. Look at Nikola. What's Nikola at right now? All right. Max price. February of 21, $24 a share. It's now at $7. That's a 65% drop. I'll give you that one again. Tattooed Chef. Peak price at 25, it's at $12 now, 50%. This is one of the good ones. It's only down 50%. Give me another one that was a hype stock. Neo. Was Neo a hype stock?
Oh boy.
February of 21. Go look at our videos, guys. We don't delete videos unlike these other idiots. Stock Mo, Tom Nash, all these guys, they delete videos after they're wrong. They delete them. We don't delete videos. I'm okay being held accountable. I'm okay being held accountable to my decisions. I'm absolutely okay. Absolutely okay. And Alibaba, for those of you criticizing Alibaba, we'll talk in 5 years. I always say I'm in this for the long haul. I'm not in this for tomorrow. And I have proof. When people email me and send me messages on Instagram saying, Paul, you were right on this one. I'm like, whoa. No, I'm not right yet. Guys, it's only been 3 months. Talk to me in 5 or 10 years. That's when I want the thank you. And I have proof of saying that. Just like in 08 and 09, I have proof that I bought. When everybody else out there who says they bought, I say, prove it to me. Oh, well, I can't disclose those things. Give me another stock, Seth. What's another stock they all hyped?
Gosh, there's just so many. People were very big fans of Peloton in the 180s. They were showing...
oh, yeah, Peloton. Oh, my God.
They love Peloton at 185.
And I remember saying to people, guys, is it possible that Peloton just is going to continue its growth that it had in the last year because of a shutdown? I said, no. It is $25 a share from a peak of 157. 157. It's at $25 a share. That is an 80% drop almost. Come on. And I love Peloton. I have a Peloton downstairs. People are going to say you were wrong on Tesla. Sure, I was wrong on Tesla. Hold my beer. Just wait. Just effing wait.
So if you're out...
I do believe Tesla falls 80-90% from these levels.
In the end, if you got burned by listening to these other people who just told you to buy these companies before they even had any income, I know Paul can sound brash, but in every video we're told we're stupid, but in the end, we stupidly didn't lose 80% of our money on some stock. We stupidly sat here and analyzed companies in a proper way.
The stupid decision I made was buying Alibaba for $155 a share average, and it being down 20%, and it generates tons of cash flow and tons of profit, and they're buying back shares. That's my stupid investment. All of these companies, the workhorses, all that stuff, Tesla's different. They started making money now, finally. Workhorse, sick. 1.75 million in revenue. Alibaba makes that in about 2.5 hours, and I'm not kidding. Alibaba makes that in like literally an hour and a half. Please stop saying I'm dumb, because I buy a beautifully cash flowing business with increasing revenue and increasing. People are mad at Alibaba because instead of growing 23% last year, they grew 20% last year. Think about that for a second.
Yeah.
It's to me, it's a no-brainer. For me, I'm going to own it for a long period of time. But if you can't stand Alibaba going to $80 a share or 60, don't buy it. I'm okay if it goes to $80 a share. Okay, I'll just buy more. Sounds good. I'll just buy more.
Guys, be careful out there. We're investing. Paul, we push the idea of a process. Have a defined process that you can stick to come rain or shine. You'll probably lose more than you win, but when you win, it'll be a great gain. And along the way, you won't have these enormous volatile losses, especially around earnings on a company like Qualcomm or Facebook. So just be careful out there. We'll be here to guide you.
Do we want to do Qualcomm in the stock analyzer tool?
Sure. Show them, Paul. That's a good idea.
All right, guys, so we're going to Qualcomm. Let's put in our stock analyzer tool. This is the most famous part of our software. It allows you to put in your assumptions of the future and tell you what you should pay based on those assumptions. Okay, I'm going to go conservative. I'm going to go 5, 8, 11% revenue growth. Profit margin, I'm going to go 18, 20, and 22. Free cash flow, I'm going to go 21, 22.5 and 24. And PE, I'm going to go 14, 16, 18, 14, 16, 18, and 12.5% return because, guys, I can get 9 or 10% by buying an ETF. So for a good margin of safety to buy an individual stock, I go a little bit higher. Too expensive. So even though the disconnect is happening, I just don't want to touch it. It's barely, the best value here, and I could be wrong on my assumptions, but remember, we don't know the future. We don't know the future. I'm the kind of guy who wants to make conservative assumptions and then buy when it's below that. Like my Facebook assumptions. Look at my Facebook assumptions. I'm buying it. I'm a buyer of Facebook. That's it. It's very simple. I'm a buyer of Facebook. At these but you shouldn't follow me. I'm just trying to teach you a process here. Go find stocks that make sense to you. If Facebook doesn't make sense to you, do not buy it, even if everybody in the world says. Warren Buffett and Charlie Munger own Verizon, and I have no idea why, so guess how much Verizon I own? 0, because I don't get it. Even though the two best investors of all time own it. I just don't buy it. That's the part of what I want you to learn here, is being an individual, learning your own process.
If this process speaks to you and you've never had any guidance in your life, you can join everythingmoney.com or patreon.com/everythingmoney. For our overseas folks, you can join our community. You can get the software behind Paul. You can analyze companies using the financials. You can use the stock analyzer tool and make better investing decisions to avoid the workhorses, the CCIVs, and all the horse shit that a lot of other YouTubers are. A lot of YouTubers are pushing. Look at this company. Remember this big? Anymore? Gosh, look at that. There you go. Well,
wait, no, this is something else. CCIV. Wait, what?
Go to the second one.
That is the second one. $11.74 a share.
Down from 40 or something.
$40.
Yeah.
Go look at your Stock Mo. Go look at your Stock Mo video about Churchill Capital, you idiots.
I bet he's deleted them. So, all right, Paul, that's our take. Yeah, join the community if this speaks to you. If it doesn't, you can keep trying, keep throwing darts at random companies. But this is our process, and if it resonates with you, we'd love to have you on our team. So, see you next video, guys. Fondle thumbs up on the way out. I love that. See you, Paul.